Welcome to Subramani. These are really difficult times for an investor to stay invested. First, you have some amazingly dumb people, whatever you want to call them, who will keep on calling out on fund managers saying fund managers are buying shares at very high prices. This is not a time to be buying shares. And since this is not a time to be buying shares, you should stop your SIP. I've heard this advice. I've heard people saying fund managers are giving exit to venture capitalists and private equity people and to private investors by buying their shares at a very high price. But remember, some of these allegations were made 2 years ago also, and people were buying, people made money also. People lost money and people made money. On something like Paytm, I have made money. I bought it after the crash, right? So in something like Zomato, I have made money after it fell. I've done an SIP and I made money. So it's wrong to say that certain shares should be bought, should not be bought. That is exactly why you're giving it to a fund manager. Let that fund manager decide. Don't believe all these people who are managing some small amount of money in their own private capacity, which is not available in public domain, but they will all come and tell you what a fund manager should do. A lot of such people saying you should not be doing your SIP and stuff like that. So let me put it this way. These are bad times or difficult times because last 1 year return, let's say you have done a mutual fund in which we are in 2025, so in 2022, 23, 24 you got very good returns, and you told your mother about it, and your mother went and told your father that look, you put money only in post office and stuff like that. See, my son is so smart, he's made so much money. So you thought you were very smart in 2022, 23, 24, but in 2025, let us say you get minus 5% return or something like 4% return, plus 4%, right? Again in 2026 you get poor returns. Again in 2027 the returns are not too good. This is the time when everybody in your family will turn around and say, I told you, you should have sold when the market was high, but you didn't sell, right? So whether they told you, didn't tell you, right now they're going to tell you that they told you. So that is one risk which is going to happen. So it is very important as part of your investment process. You have to teach your family that equity will vary. There will be a standard deviation in equity. It will go up, it will go down. These are like waves, they never stop. So it will keep going up, going down, and you have to stay invested, and SIP will work. If you did not know this, bad luck, but if you knew it, it is important for you to convey this to your family. It's also important to convey to your family that look, this is not some great skill, but I need to develop the temperament to invest, which is what I'm doing. So now don't test my patience. I'm also learning. But don't keep telling me, oh, if you're put in PPF, your money would have doubled here, it has not happened, and things like that. These things you will have to hear, and you will have to hear these taunts not only from your family but also from the great, fantastic media that we have, because or you will hear it on social media. Social media, somebody will make a video saying how SIP did not work in the last 3 years and stuff like that. How are you going to handle all this? Because making money in the market is not so much about picking the right stocks. That is of course there, but if you don't know that and you pick up a mutual fund, then it is all about your temperament of sitting tight during such times when people are taunting you, right? So it's important that you involve your family and tell your family, maybe father, mother, husband, wife, father-in-law, brother-in-law, whoever it is, friends. Tell them this is what happens in the market. This market was very good. Now next year market could be bad. So we were expecting 12% return. We have got 18%, which is fantastic. We did not expect this, right? So sometimes there will be a up, sometimes there will be a fall. And when it is up, people don't tell you. People say, so we knew that SIP works. Have you done it? No, I have not done it. Or I have done for 5,000 rupees when the CTC is 15 lakhs. I've seen such people. And they're very excited about that one SIP which they're doing and saying, oh, it's doing very well. Will they put more money? No, they're scared. So amidst all this, you have to navigate your investment ship, and that is not going to be very easy. So if you have an advisor Is he talking to you enough, right? Is he communicating to you enough? Is he saying, look, this is what is happening in the market and you don't have to worry? Is he hand holding? That's a very important job for an advisor. In fact, this video is I'm doing a hand holding for you, generic, right? It's not very specific to you, but this is one thing. Communicate with whoever, either your financial advisor or you have YouTube videos like this, or other YouTube videos who are coming to tell you that, look, Mark, you will make money in equity. If in one particular year you don't make money in equity, does not mean you should sell and go away, right? So communicating, your financial advisor should do, people like me should do, and people who are responsible enough to make sure that you stay long enough in the market to make money, because we have made money in the market. And it is not as though when I lose money, I feel very good and say, it's okay, I've got so much, so it's okay to lose. No, it hurts, right? Making losses is not something which anybody likes. So you make losses, you make gains, but you have to have the grit and determination to sit through bad times. That is what makes you money. So somebody has to tell you that. Second, your financial advisor may have to come and sit with you and do some tactical allocation for some of your short-term goals. If you have short-term goals which have to be met 2 years from now or 3 years from now, that money may not, it may not be best to keep all that money in equity. So you keep 50% of that money in debt and 50% of that money in equity, or maybe even 70-30, 70 favoring debt, because the event is only 2 years away or maybe 2.5 years away, right? So he has to be doing your asset allocation. That is another job which a financial advisor should be doing, apart from communicating to you, saying what's happening in the market and why you need not worry, your goals are far away, right? So that communication has to be there. And sometimes it is require that, you may require a reassurance more often. Somebody may require it once a month, somebody may require it once a week, right? So somebody may require it once a year. So depending on whom you are, your financial advisor should be doing that, or you should be watching this video again and again. That's it. Then rebalance your portfolio. And also one more thing is something which more chartered accountants, etc., will understand, is do some tax loss harvesting. You bought a share, the share price has gone down, you're going to buy more, that's fine. Sell it off and buy it again, you get tax loss harvesting. It's not so difficult, right? So do it, right? So do it, or buy it in your wife's name, sell off your holding. Let's say you bought 1,000 shares of a company X at 80 rupees. Now it is down to 60 rupees, but your conviction is still strong. You still think it's a good buy. You should buy the share. That's what you feel. That's a great idea. But if you want to book that loss of 80 to 60, sell off in your account and buy it at 60 rupees in your wife's account, right? Tax loss harvesting, directly, indirectly, you're capable of doing it. Do all that. Talk to your chartered accountant. How is tax loss harvesting done? And then go about doing it, right? So these are some of the things which you can do, which your financial advisor should be able to help you. He should be able to help you with this communication bit. He should be able to help you with that reallocation, or rather removing from debt and putting in equity, or removing from equity and putting in debt, whichever way, rebalancing is necessary. And third, suggesting things like tax harvesting, which you also understand, then do it. If you don't understand, don't do it. I know people who make a mess of it and then wonder what is the benefit of doing this. You lost the benefit in planning taxes very poorly. That's it. So some of these things which you do will enhance your return, but far more important, it will mean the family around you who is the influencer in your life. These are the people who will perhaps drive you mad and force you to remove money from equity exactly at a time when you shouldn't have removed everything, right? So be careful about these things. Like I said, these are tough times for investing, but you are smart enough to be there, right? Thank you.